during that networking hour. So when I talked to Rob about 2 months ago and invited him to this conference, he had mentioned a survey that SaaS Capital had recently conducted. If you flip to pages 12 and 20 in your show book, there's an article in there called 2017 Private SaaS Valuation Data and Why Your Company is Probably Not Worth 10 Times Revenue. There's also a link to the full report if you're interested. I wanted Rob to come back on stage to expand on this topic a little bit. So SaaS Capital has surveyed hundreds of companies. They have a really impressive portfolio, and I think some of the metrics and statistics that Rob will run through will be helpful in helping you understand how to position your company. So please welcome back Rob.
All right, everybody. Fair amount to get through, so in 15 minutes, so we'll kind of fly through it. But that was exactly what it is. So we did a big white paper and a big research effort on valuing private SaaS companies to share data with you guys so that we just had the investor panel. So you are very well prepared for talking to investors, and you can have a really mutually beneficial conversation and everyone's on the same page and understand the metrics for driving value. So we are a specialty lender. We provide growth debt to SaaS companies, and as part of that, we offer, or we require warrants in all of our deals. And so we're constantly pricing equity with our portfolio companies, and then they're frequently exiting, raising venture capital, and raising private equity. So we see valuations in the marketplace all the time, have a lot of data internally, and then we also partnered with a group out of San Francisco called the 451 Group. They are a research group, and they shared with us 800 transactions over the last 2 or 3 years. So we had a really nice data set. So those are all private transactions. So we had a really nice data set to work with, to compare, and to develop this model for you. So we're going to try slides. Okay, great. So I'm going to read a short bit from the research report. As we said, the whole report is on our website. You guys can go download it. It's free. There's the article, the story version in your book that gives you a nice overview as well. And that's what we're going to spend some time talking about today. So these are the most concise sentences from the article. So I'm just going to read straight from them because I couldn't say it more concise myself. But like all businesses, a SaaS company is worth what a buyer and seller can agree on, and based upon an estimate of the current value of its future cash flows. Now, SaaS companies, as we talked about, have really high gross margins and could throw off lots and lots of cash if they wanted to, but instead they're reinvesting all their money back into sales and marketing. And importantly, especially when we talk about annual upfront payments, their P&L might show a negative net income line while their cash flow break even. So using the typical price to earnings ratio that is used to calculate valuation for traditional businesses isn't as effective. So what we use in the software world, you're probably all very familiar with, is a multiple on top line revenue. And so the very first thing is to understand when you're valuing a business, you need a baseline. And then we'll look at the individual company-specific drivers on value to adjust off of the baseline. So the baseline we use is an index of public SaaS companies. And here it is for the last 10 years. And we can see it move all around during the time. We've got the financial crisis. And then interestingly, quickly, about a year ago, the public markets decided they weren't so excited about this whole growth thing with losing money, and they wanted to understand how these SaaS companies can make money. And so they started to reward profitable companies, and they started to pull out of the ones that were losing money and high growth. So valuations dipped significantly, you can see that. And so what happened was all those companies said, all right, fine. And they dialed back the growth, they increased their profitability, showed the market they can do it pretty much within a quarter. And the public market said, okay, we believe you. You can get profitable if you need to. Go back to growing. And so over the last 9 months or so, valuations have risen back up to where they were before. So that's our baseline. 6.4x is the current, as of February, is the current index of public SaaS companies. That's what the average SaaS company is trading at today. And so then what we do is we apply a couple things that are specific to a private SaaS company to figure out what your company value is. Boom. Okay, so the macro environment sets the baseline, right? That's the average public SaaS company. And then there's one other bullet on here that's not on here that's important, is what is the average private SaaS company going for? And then below that, the growth and scale of your company's revenue, your addressable market size, your retention rate, your margins, and your customer acquisition cost. So through that data that I was talking about, our portfolio, 451 Group's data, we've arrived at a number that for an average small to medium-sized private SaaS company, there's a 1.3x discount to the public market. So if you have average metrics, like on the previous slide, and you're a smaller private company, you're worth about 5.3x. Compared to a public company of 6.4x. So this is important, right? This is why the title of that thing is, you're probably not worth 10x. Sure, TechCrunch, we love reading the articles, the headlines that say XYZ sold for 10x or 12x or 22x or whatever. Not average, right? So I think that's the important thing with this, is that average companies, our own portfolio, 5.3x is pretty average. We've had companies sell for less than 3. We've had companies sell for 8.5. And so this is the range. But what is an average company, and what does your valuation look like if your metrics are outside of the average? So the first driver, beyond being private, and sorry, the private discount is because it's a smaller company and there's no public data on it, so shares are illiquid, so for investors it's an illiquid investment, and just the data isn't publicly available and trackable like a public company. So for all the reasons, MBA reasons, private versus public, there's the discount. Valuation driver on growth and scale. This is a chart of public companies, and it just shows you that growth rate on the bottom, the faster you're growing, the more the market rewards you in terms of valuation. So Shopify is crushing it, and they get a 12x valuation. But then also the size of the bubbles is important, right? So you've got Salesforce and Workday in there, so you can also see that scale impacts valuation as well. And then you've got Aptio and some of these other smaller ones are being penalized in the market. Jive for low growth and being small. Good? I'm trying to also hurry so we have time for questions too. So valuation is driven by growth rate and scale, almost like within 90% of the R squared is driven by these two things. So in our, quickly first though, it's important, so that's, you may say, okay, great, Salesforce is growing at 20%, right? I'm growing at 40%. I should get a 7x or 10x, whatever. But importantly, they're doing $10 billion worth of revenue, and growing $1 million of revenue to $2 million of revenue. I've got a 100% growth rate. Well, you're growing $1 million to $2 million. They're growing $10 billion to $12 billion, which is a much harder thing to do, right? So it's important to compare your growth rate to that of your peers. So this is where that SaaS survey data came from. We just closed it this week. We're going to be doing a whole bunch of research on it as well to share with you guys. But this is straight from that data, fresh, hot off the presses. No one else has seen it. You're the first. So these are the growth rates, the average and the median growth rates for companies of different sizes from that survey. So it's a good way to, this goes back to the private discount, right? What does an average SaaS company, private SaaS company look like? And so you can see that, okay, for a company that's doing $5 to $10 million, average SaaS company is growing 30 to 45%. So that's a good starting place for average. So back to, I'm growing at 40, Salesforce is growing at 20, well, you're actually right in the middle, you're doing 40, your average compared to your peers. So this is starting to give you a band with which to value your company. Here we go. So this is the framework for how to apply these different metrics to your valuation. So if the starting point is a company with less than 40 million in revenue, growing at 40% growth, average gross margins and average net retention rate, then if your growth rate is around 40 to 50%, then you're less than 5 million in revenue, you're still about average. If you're a little bit larger, your growth rate doesn't have to be quite as high to be sort of average, if you will, to maintain that 5.3. But growth rate, again, these are the growth rate and scale of business are the main drivers of value. So these are these really long bars, right? They can massively impact the value of your company by 2, 3, 4 turns of revenue, right? So this is sort of the starting place. So this gives you, again, a little bit of a sense for where valuation can move and why. Next on the value drivers is your total addressable market. This one, basically investors and acquirers are saying, if it's not huge, maybe a penalty, it's a little bit smaller. See the red line is a little bit shorter than the growth rate one. But there's not a real upside, right? Just because your market is particularly large, there's not really anywhere to go beyond big. So there's only really a penalty in this area for not having a particularly large market, although it's a smaller impact certainly than growth and revenue scale. Retention rate's key. This is a really big one. Arguably, it should be above total addressable market, but often investors and acquirers will stop dead at certain market sizes, so we put it there. But retention rate's really big on SaaS market. You heard me talk about it this morning. It's one of our big focuses for underwriting and for monitoring. We actually have a covenant based on retention rate, so we track it really carefully, and you should too. And so 80 to over 100% is really a good range for being sort of average. You get great credit for having negative churn, because I mean because that'll impact your growth rate. It's fantastic, right? So negative churn on up is a really good way to drive value. You can get hit. I would argue that this line is actually exponential on the negative side for bad churn, right? The lower your churn, the faster that valuation will drop off. Gross margin, so if there's a particularly a reason why you have higher margins than sort of average software companies, you can certainly get hit for on valuation here as well. On the upside, it's kind of like market size. You know, it's really hard to get above 90% gross margins for pretty much anything. So there's sort of a limited upside on that side. But if you have a big data component or a big third-party application that's a big cost component for you that could impact your valuation to some degree on the negative side. And then payback period, so unit economics. We talked about this morning. It's an important component as well. This is capital efficiency. You know, I mean, if all of these things are related, right, and they all come back to growth and bottom line to some degree as well, how much you can reinvest back into the top line. And payback period certainly is one of those. So, like I said, one of ours that we look at is less than 12 months. So if your payback period is less than 12 months, that can be impactful on your valuation as well. If it's longer than 12 months, a little bit of a negative, up to pretty significant if your payback period is very long. I flew through that because I wanted to have time for questions and I wasn't given too much time. But any questions on how this works, where the data came from? In the actual white paper on our website as well, there are 2 case studies from 2 of our companies. One of them was slow, if I remember right, one of them is fairly slow growing, had some other good characteristics but was growing slowly, and so its valuation was, I think, 3.6 times ARR. And another one had a payback period that was about a month and a half, was growing astronomically. It had a couple things that were about average on it, and it went for 8.5 times. So it shows you actually how these things move in reality and how they kind of come through to the final number. Lastly, the one important thing is this is today, right? If we go back to that very first slide, if you were to go out to market and raise money a year ago, your baseline would be 3 times ARR for a public company, and that's where you're starting from. And then all of these adjustments happen on that baseline. So the public company index is your macroeconomic baseline, and then this stems from that. So it's also important on what's happening in the broader market when you go to sell or raise money. Any questions? Sure.
When you talk about the multiple of revenue, is that based on the trailing 12 months, or is that the current month times 12?
It's a good question. With private stuff, it's a lot easier to just say run rate. So current, maybe the last 3 months average or the last month or whatever, depending on how smooth your revenue is. The public markets, it's a little trickier because sometimes they report forward, sometimes they report last quarter. So you just got to make sure it's apples to apples. It doesn't matter. This is based on run rate. So this is based on run rate. Whatever you use, just make sure it's apples to apples with whatever your company is doing. So this is run rate. And that's pretty common in the private markets, is to base everything off run rate. Public markets, they do different things.
Are you using these valuations for getting additional funding, or are you using these these valuations for selling the companies? And if so, who are you selling them to?
When you say you, so we're a lender, okay, and so we have loans outstanding to companies, so they just owe us money back. But we have warrants in all of them, which is a small option to buy shares. So we'll use a framework like this to determine the warrant value.
The valuation for you guys?
For our option to buy the shares, that's right. But then they use this framework, or you can use this framework for raising money or for selling. It's about the same. There's no real discount or premium for selling equity or selling the business. There's no difference in the framework you might use if you wanted to raise money or if you wanted to sell.